Good, welcome everybody. We are right on time. We will just wait 2 or 3 minutes for people to connect. You're already almost 100 participants, so that's great. We are expecting today more than 400 people connected. So let's wait 2 or 3 minutes and we start. Okay, we start to have more and more people connected. That's great. Thank you very much. I think we will start yes, gently, letting people connect, but we have a pretty busy presentation for you today with a lot of things, a lot of discussions with Jérôme. So welcome once again to our Ocean Shipping Transport webinar. The main idea of this webinar with Jérôme, that is our shipping expert at Upply, Jérôme de Ricqlès, and myself, so Thomas Larrieu, the CEO of Upply. Our objective today is to talk about ocean shipping transport, to use the material that we have published in December and in January, in December 2025, and in January, so this month, 2026, with an idea of talking about the markets, what happened during last end of year, and the main target will be what are the scenario for this year to come. So let me show you our schedule for today. First, I will introduce very quickly Upply for the one that don't know yet what is Upply, what we do, which module, which tools we will use today during this presentation with Jérôme, and also one new product that we will launch in 2-3 weeks now. Then we will go in the current state of the shipping market. Then on the 3 scenarios for 2026, this will be these 2 parts. The second one and the third one will be the main theme of the main focus of this webinar that should last about 30 minutes. Please ask Q&A, ask questions, okay? We do have a Q&A that is open. You can ask questions directly by writing on that. We will not take questions by vocal question, by oral. So please put your questions directly in the chat, and we will try to answer it on the flow, on the way. And at the end, if we still have some questions, but please feel free to interact directly during this webinar. This is not a pre-recorded webinar, so please use that functionality, let's say, to interact with Jérôme and myself. Okay, let's start. Quick presentation about Upply. We are a company on the intelligence transport management sector. Our main target is to use technology and data to work on the supply chain and the transport efficiency. At Upply, we have tech people, data people that are directly working together with experts like Jérôme, for instance, to create functionalities, to create tools. The one that we will use today is what we call the ocean freight. It's part of the ocean freight applications. And the one we will use is the dashboard and analytics one. The main idea here is to collect data, transactional data from the market, from real actors, carriers, freight forwarders, to monitor the freight spend, or to monitor the market's evolution. So this is the one we will use today with contract spot data, long-term, short-term view, and for sure with the knowledge of Jérôme and the knowledge that we have at Upply on all these topics. Before going directly in the presentation, I will just introduce something that we have been testing for 6 months now. It's working quite well. The idea that we have over there is to publish an AI copilot for freight intelligence. To put it simply, we have built an AI that is very close to ChatGPT, Gemini, all the one that you know already, but our target is to be better than Gemini, for instance, on a specific field that is market intelligence for freight transportation. So we took the best AI models that are available today from the best AI labs, and we train it on data, the data that we have internally at Upply, all the market intelligence that we publish, all the webinar that we have done, all the public information, and we try to really boost this AI on these topics. This will be launched in 2 weeks, and if you want to be notified of this launch, if you want to be a beta tester of the tool, feel free to snapshot this QR code to register or to go directly on upply.com/atlas, the name of this new tool. Okay, this was for the introduction. Now we go directly in the current container shipping market condition. The topic we will discuss with Jérôme right now is based directly on the last report that we have published. That is this one over there. That is available on our website, and you will have a QR code just after also. And this is for the introduction. We see here freights index that are fluctuating. Jérôme, what can we say about that?
Yeah, welcome everyone, and very pleased to be with you again for this session in Paris, live in Paris. And yes, to start a global overview about market rates. So what kind of rates are we talking about? As Thomas underlined just previously, today at Upply, you can select different maritime freight rates from our database. Should be spot, or should be long-term contract, or should be a blended version. And we started 7 years ago with a blended version. A blended version of a little bit like the SCFI in the mindset. That is to say, a mix of long-term contract rates and spot contract rates. What balance? I would say 70-30, 70% globally, yeah. 70% contracted rates and 30% spot rates. So we wanted to start this graph back in 2024. Reason why, you may remember, all of us, that 2024 was considered as an exceptional year in terms of revenue for shipping line, mostly due to the Houthi disruption, pushing all the markets through the Cape of Good Hope. It was a game changer, a second game changer after the COVID game changer. And it impacted the rates, obviously on Asia to Europe routes, but it had also collateral effects on trans-Pacific rates and also on transatlantic rates. Big figures to have in mind, 2024 compared to 2023, it was a 60% increase average for the shipping lines in terms of gross revenue. And what we see on the screen is that 2025 will not be exactly the same picture. To be honest, 1 year ago, at this stage, the fundamentals were really very bad for 2025 when we started the year, in terms of overcapacity, in terms of ultra competitive market with MSC as a leader, really gaining and some traction on market shares thanks to a very aggressive pricing, with all the players of the market following. And you may remember back to 2025 Q3, the results published were by the shipping lines were, for most of them, quite an alarm. We have seen a little bit of a kind of upstick on November and December on the market, which maybe made things less catastrophic than they were planned to be last October, when we are considering now 2025 as a whole fiscal year for the companies. Most of them have not yet published their revenues for 2025. Except OEL, minus 10%, 10.6% on the net revenue for 2025. What we expect as an average figure across the board for the shipping lines for 2025 will be to publish net revenue between -10 and -30%. So it has not been, 2025 has not been the bloodbath that it was supposed to be.
That was expected indeed.
But clearly, it has not been a second time in a row, the exceptional year that 2024 was. So it is interesting because you may remember that now we are starting this new year. There is a lot of threats everywhere, geopolitical threats, war, commercial war trade, commercial war threats. We have a US topic who is too big, too big, really too big these days. So this means that we are entering this discussion, bearing in mind that we need to behave with a lot of humility about what can happen and considering the dynamics which are fluctuating too much.
And this is exactly the topic that, I mean, this is a big part of the discussions that we will have just after, and that is part of our research paper.
Yeah.
Before that, we will go on the next slides that I just tease here, talking about the global markets. And a market from an economic perspective, this is the balance between offer and demand.
Yeah.
Here on the ocean shipping part, we have a very specific balance between the two, and I should say unbalance between a very high level of capacity or capacity to become, let's say, and a demand that is a bit better but quite uncertain.
Yes, definitely. And also there is a kind of area of growth for the exchange. East-west routes to a more Indo-Pacific focus. And clearly it has an impact on the fleet. And talking a little bit about the fleet and talking a little bit about the offer, of course, it is commonly said that the big marker of the liner activity, it is that there is an endemic structural overcapacity situation.
And just on this overcapacity situation, mainly linked with the fact that carriers during the past years, I mean, just post-COVID, won a lot of money, wanted to invest in new carriers, in new boats. I mean, this is the main idea.
The big idea it is that it's a question of cycles. The positive cycles in history of liner shipping are short, and the weak cycles are quite long. So that means that Jacques Saadé had a very good theory about that in saying it is such a tough market, such a capitalistic market, such a long-term position market that you have no other choice than to grow and to be very big. Because in case when the market flip over, you have to be strong enough. And it is clearly the way this business works. In terms of offer and capacity, what is interesting to say it is, I think that we are entering into a new era. The era of the monolithic approach of the over 20,000 TEUs vessels as a key to strength is something which is mitigating now, not disappearing, but mitigating. And what we have seen this year, it was something we learned really in 2025. It was that the second-hand segment for the vessels, this market has been very, very buoyant. And second thing, it is more and more interest on Panamax and Neo-Panamax vessel, and even on smaller vessel, in order to enter in this new game of networks, of shipping line networks, of containerized networks, mostly in intra-Asia, where you need smaller vessels, and with this idea of organic network, of hyper-capillarity. And this is something the market is moving on in terms of direction, far more than the big cause between brackets on long term on deep sea.
And this is exactly what you were writing in your paper of December, that there is a soaring prices, so increase of prices for the small boats, let's say. I mean, the cost for that, the rates for the 1,000 to 3,000 TEUs, these increased.
Yes, a lot. And it is a big change because 10 years ago, for example, when you were a shipping line considering to buy 20,000 TEUs vessels, it was a bit shame. It was it was not very popular, to be honest. And because big was beautiful. So big has been beautiful. Big is still beautiful, but with an extended limit. And now the small is beautiful approach is far more considered. And it is interesting to follow. Quickly, regarding the capacity and regarding the race, 2025 has been clearly the year of MSC. That was planned, that was announced last year already. It was quite obvious that they were here to play really the market very hard and to grow very quickly. In 2025, they started before in 24 and even in 23. MSC has been hoovering the market completely in terms of capacity, in terms of fleet, and the target of 1,000 vessel, 1,000 active vessel all over the globe for MSC will be reached very soon. In terms of growth, they started 2025 at 20% of the capacity offered, thanks to our good friends at BRS Alphaliner. And now they picked up to 21.4, 21.6. So it's really a big game. And it is true that, let's say, between March and October, November in 2025, they have been the name that ruled the market. And the other had only to follow. It is a bit of synthesis. Of course, there is more than that in the real life, but if we want to give some quick explanations, it is a key marker to me.
Okay, thank you. We will move to the next one regarding, once again, end of 2025 and moving to the 3 scenarios for 2026. Here we will try to go quite quick because we have about 15 minutes left. But what I wanted to say is that clearly here, I mean, we are right now, the webinar is on the 21 of January. There is the Davos summit that is just opening right now. We are in the middle of a trade war. The US is playing hardball on Greenland with Europe. You were giving me the example of champagne. We are French, so we drink a lot of champagne for sure. But we love also to export champagne. And just an example on that. A bottle of champagne in the US at the beginning of 2025, so 1 year ago, let's take the Taittinger champagne, was about $28. 38, sorry, it's 28, $38, you're right. Moving to with the 15% that was negotiating in taxes on the champagne, moving to 48, and now there is a fear of plus 20% increase of 200, sorry, percent. Moving it to the bottle of champagne of very, very high price. Just showing that we are really right now in a trade war and talking bluntly about a war, basically. When you have China, and this is something you put also in your report of December, China that is putting ballistic missiles on carriers, on container ship.
And container vessels.
Container vessel.
Right.
This is something a bit, I mean, crazy from my point of view, a bit scary also. But let's move on that very quickly, please, Jérôme, the geopolitical environments, and then moving to the 2026 scenarios.
Always, thank you, Thomas. Yes, always bearing in mind, in terms of for you, who have to build some game plans for the year. We have to consider always some arguments in terms of balance. What can bring some tension on the market? And so, between brackets, are some arguments we will go in the vision of higher freight rates. and what can push the pressure downwards and free some pressure on rates and to get some lower rates. We have always to go from one to another and to try to balance the arguments. So, of course, last year, as I said, we started with a nightmarish situation after Liberation Day, and we have seen that we found the market found some solutions. So always believe that the market is finding some solutions, even if the things appears to be very tough. I remember early March last year when I was at the TPM in LA, the key people of the industry were very focused on two aspects. The first aspect was tariff, and it is still, of course, a threat. And the tax on the Chinese vessels from the US and the retaliation countermeasures from China with tax on vessels managed at least by 25% of capitalistic related to the US interest. And everything changes all the time. So keep calm. First advice, because what we take in the figure one day may change the day after. So as much as we can, we have to keep calm. What can we expect today regarding the latest developments of the trade war with the US related to Groenland? It is a two-time approach. Maybe some front loadings from Europe to the US in terms of wine and spirits, which should not be too much a big problem, because at this time of the year on the transatlantic route we are in a slack season. We are not in peak season, and as MSC came with a lot of capacity on the trade since 2 or 3 months now. The shippers have some option if there is a rush on orders in order to satisfy some front loadings, and it may have a short-term impact on transatlantic freight rates to give them an upstick. And after, it's another question, and of course, the current crisis will have to be solved from a way or another, and then we will take it from there. But on short-term basis, on the transatlantic, yes, the first reaction of the US retailers should be to front-loading, and as they did with China last year, but in a far less scale. For France, for example, export to the US as a whole, not only wine and spirits, it's nearly, the weight is around 20% of our export. So it's very important. And within this 20%, the share of champagne, wine and champagne is 5 to 6%. Okay, so just to give some scale. That means, of course, for this industry, it is a very big concern, agreed.
For this industry.
But if we take the big picture for the French economy, not talking about the European economy, but for the French economy, it is still something which is manageable.
Can we go quite quickly, Jérôme, on the evolving role of the port? I'm just looking at the time, and the Suez Canal that will make the
transition.
The transition with the 2026 approach.
Evolving role of the port. It was something that we highlighted back in July, with more and more threats and more geopolitical tensions. It is clear that we are entering in a new era. Happy globalization is over. I think that it is nearly understood by everyone. And we are entering in something which is more difficult to cope with, less friendly. And that is to say that in terms of ports management, for the past decades, the liner shipping ports have been only focused on cargo. And be good tool to promote exchanges, find some economy of scale, optimization. That was the keyword. Sovereignty was not the keyword. Security was, yes, due to narco traffic and due to things like that, and also security has been a keyword. But sovereignty, more or less. And today sovereignty is a top topic because everyone realized that a commercial port is a target. It's a physical target, and it is a target also as it has always been during the past world wars. And so it is a physical target, and it is also a target in terms of data, data captation, in terms of information. So security.
You need to be secure
safety,
from a physical perspective, from a technology perspective.
Clearly. And also with a growing role in the supply chain of using commercial ports as tools also for maritime navy networking, Marine Nationale or Navy networking and help in order to find some solutions for despecialize the ports between liner ports and military ports. So now we are going in the direction of something which is mixed together. And if we go back into history, it was something which was quite normal nearly 50 years ago or 60 years ago to have this mixed approach for the ports of military and commerce. Now we are entering now in this story. What does it mean in a few words? It means that some space in ports have now to be dedicated to military activities. It's quite easy in some. It's more complicated in others in terms of space available and size.
Thank you, Jérôme, for that. I will keep the Suez Canal to the next slide, using just to remind you that all we talk about is directly taken from the monthly container shipping report that I have here in my hand that you can directly download and have access here using the QR code. We are now moving to the scenarios for 2026. That is from another paper that we just published at the beginning of this month and this year. The first one is regarding the Suez Canal, the Cap of Good Hope. This is one big question that we have. So we know that for some years now, we are not going anymore to the Suez Canal, or at least very few vessels. And the Cap of Good Hope, basically, it's longer, and the cost is a bit higher. And the main question is, will the shipping lanes go back to the Suez Canal or not? What might be the impact? And this is one big scenario that you describe in your report.
Yeah. Thank you, Thomas. Yes, basically, the idea is, should I stay or should I go? Like the old song. Really like the old song. Should I stay or should I go? And it is very interesting these days because we just learned that CMS CGM, which has been very proactive in a return through Suez in sending for the first time 23,000 TEUs vessels, the Jacques Saadé, a couple of weeks ago through the canal southbound. It was interesting to see that at that time we had some hopes that something may happen to engage, to initiate a movement for a comeback through the Suez Canal. And yesterday, boom, change. Fall 1 and Fall 3 stick to the Cape route. It was an official announcement from yesterday from CMS GM. So it is a very good example. It's showing that we know that there is some choppy waters ahead. The situation related with Iran is not stabilized. The power of threat of the Houthi is still very questionable. So, of course, there is some rise, but there is no massive comeback, at least not before the end of the Chinese New Year, if the situation allows.
To put it quite simply, we have the shipping line on one hand that's let's say, prefer or have an incentive to go through Cape Good Hope. We talk about the overcapacity situation. If we start to have a shorter transit time going to the Suez Canal, it will create overcapacity again. But on the shipper side, this is not even clear that the Suez Canal might be better than Cape of Good Hope. I mean, there is always the thing that via the Suez Canal today, there is a bit of uncertainty. This is what you were talking about. If we go in this to the Suez Canal for only 1 month, 2 months, meaning that the supply chain need to adjust to go back again, this might be a nightmare. And this is really the point of the first scenario.
Exactly, a complete mess. And behind the scene, we have to hear also the shippers. And we have to think about through the interest of the shippers. The shippers have been really badly hit by COVID. They have been then badly hit by the Houthi and by the Cape disruption. And now we are at a stage, mostly for the retail players in Europe, when they just started to stabilize their supply chain again with a slightly better quality, relatively affordable freight rates, free stock on the vessels with a longer route, less D&D pressure at the ports of arrival. So there is a kind of consensus that aside the environmental topic, plus 37% emissions through Cape compared to Suez, which is very important too. That is to bear in mind. But it is clear that from the shipper side, particularly the retailers, there is not a huge demand for a mini change because they are just have a little bit of relief after two crazy crises. So we can understand them and why the route through the Cape of Good Hope may still have some good days, particularly for the biggest vessels. And that is the second point also to take in account. It is the insurance rate for the vessel. It is key. For a vessel, prior to the Houthi attack, to go through the Suez route and the Red Sea and the Bab el-Mandab, average rate to cover a vessel was 0.1% of the value of the vessel. That was what was the market offered, and that was acceptable by the shipping lines. The second point it is that after the Houthi crisis, very quickly these rates climbed to 1% of the value of the vessel, and then nearly close to 2%, making it a clear showstopper. And for the shipping lines. Today, it's interesting news, to transit through the Red Sea, we are back to 0.2%.
Okay.
So
not back to normal, but almost.
Almost. So financially, of course, it should make sense for the shipping lines to come back. But in the same sequence, there is effectively still the physical threats and also the fact that fundamentally the demand for time being is quite happy with the current consensus. And of course, for the shipping lines and for the big forwarders, it is the way to go because going through the Cape route is a buffer in terms of capacity. It is hiding nearly 12% of the needed fleet. So, of course, everybody has fears of an impact if all this tonnage go back to the traditional Suez route. So it is clearly something to look after. We have also to look at what will happen at the Chinese New Year period, end of February, early March. It should be pivotal. If there is no other new factors coming into the game, it should be a pivotal period for services to change their mind or not, taking into account the situation at the time. But of course, we see already some some effects of congestion. There is some congestion in Asia today, in the big port in China. There is some slight congestion also in Northern Europe, Hamburg, for example, and Antwerpen. So this situation about the current congestion level in the Cape ports is also very important to take into account, because it will not play in the favor of creating a new mess.
Yeah. That's an important point. We will go now on the second scenario. Just before that, because we ended the time, the 30 minutes that was planned. Sorry for that, but I think we have pretty interesting things to say again. So we will put an additional 10 minutes. If you need to go, don't worry. You will receive the report. You will receive the report first. And then also the webinar with the slides and the video. And having said that, so let's continue. Now the second scenario is escalating war conflicts in many parts of the globe, because we have today many wars that might happen and that might have a direct impact on the ocean shipping organization, let's say.
Clearly, yes, Thomas. And this is clearly due to the dark fleet situation or the black fleet situation. So even if this war at sea concerns mostly tankers, the big question is, what are the impacts, collateral impacts on the liner shipping industries? There is some different approaches regarding this question. Our good friend of, at AXS, Alpha Liner, for example, doesn't see fundamental interferences between the two. I would mitigate a little bit this approach because now there is such an escalation in the war at sea, which is not strictly focused to the Black Sea. When it was in a close sea, the Black Sea, with a story between Russian and Ukrainians, it was a bit different. But what we have seen, some important game changers, it is that there was a kind of, between brackets, no war at sea act between Russia and Ukraine to protect their interest for commerce, and particularly for grain and for oil. And so they keep free routes for this vessel for quite a long period of time during the war. Since September, with the escalation process, we have seen that this gentleman agreement between brackets is over. And now they are fighting like dogs each at sea. And the reflection, the image of that, once again, insurance rate. Today in the Black Sea, to navigate into the Black Sea, if you can be covered as a shipping line, you have to pay at least 2% of the value of the vessel. Again, a showstopper. And what we have seen, it is the escalation of this tanker war in different spots. In the Mediterranean, close to Malta, a big route. In the west of France, you may remember the story of the Boracay close to Saint-Nazaire. In the Baltic Sea, recently close to Venezuela. Okay, so it contaminates. There is a contamination, and there is more and more events in a shorter and shorter period of time.
And for now, between China and Taiwan is quite okay, but we never know what might happen in this area also. Yeah,
it's boiling. It's always boiling. And of course, they may take advantage of the over-focus on the situation in the globe in order to make some progress in another localization of the globe. And it is the big problem today with the Trump game. It is that they can't be everywhere in the same time. And we know how they overestimate their capacity in terms of maritime power. Because they have an aging fleet, they have no commercial fleet. As you say, things are changing. There is a little more and more gray area between military marine and between commerce marine, because have you seen, we learned that 6-7 years ago, it's quite easy to hide some missiles into 40-foot containers. So it's a new camouflage approach of the threats and of the power freight. So to me, and not talking about fuel prices, there is a risk of contamination if this tanker war lasts. The risk is retaliation. It is a country can say, and we have seen it with Iran. If Iran made a statement, if you strike us, our answer will be on commercial shipping, but blind, not finger pointing a country or another. So to me, it is a factor that creates tension on the market.
And the last scenario is something that honestly, when I read the paper, I didn't thought about this one. It's a return to regulated freight rates. That is not exactly the current policy, for instance, in Europe. That is more toward liberalization of the market. But this is something, in your opinion, that need to be also that we need to look at it or to envision it and to have a kind of interest or put that in our risk management portfolio.
Clearly, very basically, we are the first market of the world, Europe as a whole. If we have, in the meantime, some threats from the east and some threats from the west, we have to protect ourselves. It's as simple as that. It's a very basic approach. And at European level, we have a lot of traction in the shipping line industry. It makes jealous a lot of people, particularly the US. And we have to protect that. It is a key asset, particularly in today's environment. And we have to understand that we have to secure and to protect this asset. And to protect this asset, in order to avoid the choppy waters, in order to avoid the roller coaster, in order to offer for a fixed period, renewable fixed period, but to frame the market in a way that can offer a good balance of profitability to protect our interests, our European interests, and still be a big player. And it is the approach of the commodity box rates I am referring to in this article, which is something that the older generation from the conferences ages knew very well. It is a tool which is on the shelf that we can use for a relatively short period of time, and that can secure our assets. And I think it is something we have to think about very seriously, particularly this year when we see the escalation in the level of threats regarding Europe.
Yes, and the change also in the behavior of Europe.
So
Let's say we're in a wait-and-see situation more and more, and because also some European land like Greenland are threatened, the change in behavior is, we can feel it in Europe. So this might be something also that we need
bear
to
in mind and to consider in your game plan. Yeah.
Exactly. Thank you for that, Jérôme, for these three scenarios that are once again available on our website. At this location exactly on this QR code, I will put the three QR code that I have shown in the presentation. Meanwhile, we will take some questions. We have one question from Adam, and if you have any other questions, please feel free to put it. Do big ships mean, in general, lower rates, but at the cost of larger transit time?
Of longer, yes, longer transit time. Yes. Clearly, the big vessels, the idea of the big vessels over 20,000 TEUs, it was always economy of scale, and it was always to have a cost per slot for a container to be as low as possible in order to have a better profitability. And it's true, it can be paradoxical. If at the beginning of the webinar I said small is beautiful, you remember the traction for the small vessels that we can see today on the market. Okay. The small vessel business model is based also on short distance, not always, but the most often. So that means you have to bear in mind the rotation time. If you take $600 or $700 per 40, but on a weekly basis on an intra-Asia route, is it better than to take 2,000 on a 90 days route on deep sea from an operator point of view? And I think that to answer to your question, we need both. And big ships are workhorses, are big workhorses, and they need to be full in general to be money making because they cost a lot. And so, of course, I agree with your comment. If we take that into consideration in current environment, it may make sense to get them back to the Cape route for time being. Don't forget that a 24,000 TEUs vessel full, if you add the value of the vessel for a quite new vessel and the value on the cargo of the cargo on board, you are close to $1 billion per unit. So you can imagine the impact. The Ever Given, we all remember in the Suez Canal a couple of years ago, it was a $1 billion vessel affair between the value of the vessel and the cargo. So, of course, today the longest route makes sense if the vessel is full.
We have two other comments and an additional question that I will take also. So thank you, Frédéric. Thank you, Monica, for your very positive feedback. I will take one last question that is, the question is regarding a kind of summary regarding the three scenarios in terms of increase or decrease of rates. Okay, so the first one is, we will go to back to the Suez Canal or go through the Cape of Good Hope. These changes will have an impact or not? This is the big question.
Yeah. It's a commercial tricky game. Back to 2024, when the mandatory route through the Cape of Good Hope was there, it was a good opportunity for the shipping line to say, sorry, but we have some extra cost. We have to pass this extra cost on the cargo. Very logical. At that time, the yardstick was $1,000 per 40 foot. Thanks to optimization through the months, this differential ratio went down to $400. And now that the vessels may come back through the Suez Canal, there is some shipping lines who say to their customer, if we go back to the Suez Canal, you will have to pay a premium. So the shipper doesn't understand, because he said, hey, you asked me a premium for the longer route, and now you ask me again a premium to go back through the shore. Please, no kidding. Be serious. And of course, it has to be taken into consideration that if there is a massification through the Suez Canal, of course, with the capacity impact on rates, it will mean a way or another lower freight rates, but maybe more port congestion to pay, more congestion fees to pay. And also, we have to bear in mind, we didn't discuss about that, but we have the ETS2, which is going full steam, nearly close to full steam this year. So this will also inflate the cost.
And the ETS2, for the one that are here, and just to remind it's the market, the carbon markets, and basically the tax to pay that is already impacting today the ocean shipping, but that will impact also the road transportation,
Yeah.
so the pre-post carriage, or at least in Europe. So this is something also
Yeah.
that will have that will be a premium.
And it's a scenario where every year there is an escalation also in the rate, in the price to pay. So in terms of pure inflation, particularly if the ETS are now more and more, and that is, in my opinion, not a very good thing, integrated in the freight rates during the negotiation. I don't see huge decrease on short-term basis on the freight rates. I may say for the second half of the year, when we will have a clarification or not, but we may have a clarification on the Suez status for second half. We will have to review some factors that may be some factors that will put some additional pressure on rates downwards.
So this is another question that we had regarding the clarification of the Suez Canal. So your point of view, I'll try to summarize it, is that no big changes on the first part of the year because there is still some conflicts. I mean, no big changes on this part, on the Suez Canal. Maybe a comeback to normal, or at least to be able to have visibility for the second part, the second semester of the year.
Yeah, it is the most likely scenario, full of uncertainties, of course, nearly unpredictable at this stage. But what is interesting to notice now, it is that something is quite sure, there will be no massive rush back all in the same time, all in the same sequence. It will be done gradually, and the next step will be, and very gradually, the CMA announcement was very clear for that. And the next step will be very pivotal, will be the Chinese New Year, because during this 2 to 3 week stop in China, it is the time that usually the shipping line use to reorganize their networks.
Great, thank you. We will end here. Sorry for the additional minutes that we put here. We hope it was useful for you. I think there are still some questions we will try to answer to you directly via email. You have here our contacts. Feel free also to follow us directly on LinkedIn. Jérôme and myself are publishing quite often content and answering to the questions. That's it. I will end that by saying that once again, you will receive the replay of this webinar. You will receive also the documentation that we talked about. Thank you, Jérôme.
Always a pleasure, Thomas.
Me too. Hope that it was great for you too also. We will have another webinar like that in some months. Hope to see you there and have a great day. Bye, everybody. Thank you.
Bye.